Subcommittee on Financial Institutions is now recognized for 5 minutes.
Thank you, Mr. Chairman. Dr. Michelle, thank you for your lone dissenting voice in Leslie Stahl's biased and one-sided 60 Minutes report on DOJ's audit of the CFPB, which, as you know, is funded entirely from the Fed. In Ms. Stahl's critique of DOJ's access to personal private financial information, she failed to point out, and by the way, former Director Chopra also failed to point out, that the only reason why DOJ had access to that information is that the Bureau itself collected that information. So let me just ask you to correct the record for 60 minutes. Would DOJ have had access to personally identifiable financial information of Americans had the CFPB not collected it in the first place?
No.
No. Okay. So can you also inform the American public who maybe were misinformed by that 60 Minutes interview what happened with all of that personal financial information that the CFPB collected in I believe it was March of 2023 when the CFPB experienced a data breach?
They had a data breach. So, a lot of people got access to information that they shouldn't have had access to because that was collected in the first place.
Yeah, so what's the greater threat to Americans' financial data privacy, the CFPB or DOJ?
Well, I did answer on that interview. I don't know that it got made the segment, but I said I have no greater concern that anybody in the administration now has access to that information than I did that the agency, the Bureau itself had. So I would say, yeah, my problem is that they have that information to begin with.
Yeah, exactly. So let me ask you this. Does the Fed's role in funding the CFPB politicize the Fed?
Absolutely. It should not be set up that way.
So if you're concerned about politicization of the Federal Reserve, why don't we, how about this, take the Bureau away from the Federal Reserve and subject it to the congressional appropriations process? You think that's a good idea?
Absolutely.
Yeah. Let's join in a bipartisan way, reassert Congress's appropriations authority, and actually depoliticize the Federal Reserve by taking the Bureau out of the Fed. Bank regulation. Mr. Wang, I want to ask you about the bank regulation's impact on monetary policy, specifically the way the SLR is currently calculated, disincentivizing banks from serving as intermediators in the primary, secondary, and repo markets for U.S. Treasury securities, decreasing liquidity in the Treasury markets. Mr. Wang, would an increase in market liquidity and stability help bring the long end of the yield curve down, which would in turn reduce mortgage rates and therefore reduce the cost of living for Americans?
I believe it would.
And does this give the Federal Reserve, would this give the Federal Reserve greater flexibility to lower the Fed funds rate and ease monetary policy?
Yes, it would.
So this is very important for all of us to remember. If you want to lower interest rates, if you want to lower inflation, the Fed needs to focus on deregulation. And especially with the SLR. Let me ask you about the balance sheet, and I'd like Dr. Cohn to weigh in on this. You know, shrinking the balance sheet on the one hand obviously pulls the money supply back, and from that standpoint might be disinflationary. But also shrinking the balance sheet decreases demand for treasuries, possibly pushing upward pressure on the 10-year. Is shrinking the balance sheet inflationary or disinflationary?
I would say it's disinflationary to a minor extent. For the reason you said, pulling it back probably puts a little bit of upward pressure on that 10-year. Okay.
Let me ask a final question. A lot of conversation about the 50 basis point cut in September. Certainly, even if Chairman Powell is right that they're not focused on politics, the perception was really bad. It was a bad look 2 months before a major election to cut that aggressively 50 basis points, in my view. And was this a mistake? Because even though the federal funds rate was cut aggressively, you still had an increase in the 10-year at the same time. Anyone?
So I don't think the increase in the 10-year reflected the cut in the federal funds rate. There was very little increase in inflation expectations as measured in the market. It was mostly term premium over the next few months, and that's about uncertainty, uncertainty created by the election, by financial and economic developments. So it wasn't really about the cut in the funds rate.
Well, obviously, the 30-year fixed rate mortgage shot up
Right.
despite the rate cut, and
Gentlemen's time has
inflation's
expired.
still a
I would
problem.
also flag that that summer we had breached the SOM rule, so many people were quite worried about an incoming recession, and rates were quite restrictive at that point. So the 50
Gentlemen's
basis
time has expired. The chair now
Thank you. I yield
recognizes
back.
the gentleman.